All right, now I'm recording. I'm going to turn my camera off. That makes for a higher gigabyte file whenever I go to upload it because it's recording the video with the camera. If I turn it off, the file size won't be as big. It'll be faster to upload. All right, back to sharing. Chapter 10. All right, what am I doing? I'm going to the wrong place. I need to be going to the book here. So let's do the first exercise in set A. So give me 1 second here. Let me pull up the solutions. That way I make sure I'm not showing you guys something that's wrong. Apologize for the delay. All right. So it says for each of the following situations, indicate the amount shown as a liability on the balance sheet of this company at December 31st. So Cooper has accounts payable of $120,000 for merchandise included in the year-end inventory. So for that one, for part A, what amount should be shown as a liability? It's just accounts payable, $120,000. It's a current liability. I'm going to put CL for current liability. B, Cooper agreed to purchase a $30,000 drill press in the following January. Nothing's happened this year. No transaction has happened that we have to account for. So nothing is recorded for this in the current year. We've basically just told someone else, we're going to buy the drill press from you next year for $30,000, but we haven't done anything. They haven't given us the drill press. We haven't given them any money. We just said we would buy it. Part C, during November and December of this year, Cooper sold products to a firm and guaranteed them against product failure for 90 days. Estimated costs of honoring this provision next year are $2,200. So they estimate that, a portion, $2,200 worth of stuff is going to fail. They're going to have to pay that. It's kind of like a warranty. And so from the standpoint of this year, it's $2,200 of current liability. More specifically, it's an estimated liability for product warranties. Which we're according to GAAP, the company has to make an estimate. If they sell a product with a warranty guarantee to customers, they have to make an estimate at the end of this accounting period of how much they're going to have to incur dollar-wise to satisfy the warranty, which means they have to estimate, all right, how many of our products are going to fail and be returned to us, and then we're going to have to give the customer money. D, on December 15th, Cooper declared a $60,000 cash dividend payable. So on the 15th, they declared a cash dividend of $60,000, and they said that they're going to pay that dividend on January 15th of the following year to shareholders of record on December 31st. Of record just means as long as an individual owns the stock as of December 31st, they're going to be eligible to receive a dividend. So there's 3 dates with dividends. There's the date of declaration, that's the 15th of December. There's the date of payment, that's January 15th. And there's the date of record, which is the date, as long as you hold the stock on that date, own the stock on that, as of that date, you get the dividend. So you don't even have to own the stock on the date they declare the dividend. You just have to own it on as of the date of record, and you're going to get the dividend. So anyway, we'll learn more about dividends in Chapter 11. But what's the liability related to this as of December 31st of this year? It's called dividends payable. It's $60,000, and it's a current liability. It has to be satisfied within a year or less, so it's current liability. Journal entry would be credit dividends payable for $60,000. Debit, depends on what method you use, and we'll learn about this in Chapter 11, but debit, essentially retained earnings. Dividends come out of retained earnings. And is there another one? Yeah, E. Cooper provides a profit sharing bonus for its executives that is equal to 5% of the reported before tax income for the current year. The estimated before tax income for the current year is $800,000. Is there a liability related to this situation? Yes. It's called bonus payable, right? They owe a bonus that's 5% of $800,000. So 0.05 times 800,000 is a $40,000 current liability called bonus payable. So that's the exercise 10-1A. Are there any questions regarding this particular exercise? All right, I don't see any. Let's go to the next one. So we'll do 4A here. Adjusting entries for interest. The following note transactions occurred during the year for town. So there are 3 transactions that happened, 1 in November, 2 in December, and it wants us to prepare the general journal entries necessary to adjust the interest accounts excuse me, at December 31st. What journal entry is required on December 31st relating to the November 25th transaction? Well, let's see. What happened on November 25th? Let me look here for a second. So on November 25th, we issued a 90-day 9% note payable for $8,000 to Hyatt Company for merchandise. So on December 31st, we need to recognize some interest expense relating to this note and the related interest payable.
We don't have to pay it though until, what's 90 days after November 25th? March 25th? But as of December 31st, we need to recognize that how many days have gone by since November 25th? You can just assume 30 days in a month. Keep this simple. November 25th through December 25th is 30 days, plus an additional 6 days, right? 31 minus 25, December 31st. You can actually, November has 30 days, December has 31 days. So it's 36 days between November 25th and December 31st. So we need to recognize 36 days of interest expense. So on 12/31, we make the following entry. We're going to debit interest expense. Credit interest payable. We don't have to pay anything on December 31st, but we do have to recognize interest expense for the so this is the little note to accrue interest expense for the Hyatt Company note. And the question is, how much, right? 36 days worth. So we go back. Interest expense on a note is calculated as principal, 8,000, times annual interest rate, which is given 9% right here, times time. How much time? So 8,000 multiplied by 0.09, 9%. This would give us the 12 months of interest, or 360 days of interest. Remember when we talked in the previous chapter, when it comes to these interest calculations, there are 360 days in a year. It's in a previous video. I know there's 365 days, but we say there's 360 to make the calculations, make the numbers that result from the calculations to be less decimals and more whole numbers. So this is 360 days worth of interest. We want 36 days worth of interest, so we multiply by 36 over 360. And then that gives us the number that we need to put. So it's $72. And if I put a little star by 72, this is how that was calculated. So that's the first part. Let's go with the second one. On December 7th, we signed a 120-day 30,000 note at the bank at 10%. So we borrowed 30,000 from the bank, December 7th. On December 31st, we got to recognize interest on this note that we owe the bank. Even though we don't have to pay them yet, we will pay back the principal and all the interest 4 months after December 7th, 120 days, essentially. So how many days elapse between December 31st and December 7th? 31 minus 7, 24. So we need to recognize 24 days of interest expense. Same journal entry, so I'm going to copy and paste the same debit and credit accounts. It's just the number changes. So we'll put a double star by this number. And what's the number going to be? It's going to be principal, which is 30,000, times the annual interest rate given, 10%. Let's go back. 30,000 principal, 10% interest. and then multiplied by the time. How much time? 24 days. This is interest for 360 days or 1 year. So this is interest for 24 days. And you get $200. How do we come up with the 24 days? That's just December 31st minus December 7th. Somebody have a question? Let's see. No questions. All right. And then the final one. We borrow $12,000 from Bar Incorporated. In exchange, we give them a promissory note. We promise to pay them 4% interest annually, and we promise to pay them back in 60 days. So on February 22nd, we'll pay them back. We'll pay them back the $12,000 plus the interest we owe them. 9 days later, the end of the accounting period comes, time to make adjusting entries. So December 31st, we have to recognize interest expense on this note. Interest expense for 9 days. So again, it's going to be the same debit and credit accounts. And the number is going to be principal, $12,000, times interest rate, times annual interest rate, 4%, times time. How much time has elapsed? 9 days out of the 360. And that's how you get this number, which is $12. Kind of silly to recognize $12, but hey, got to follow the rules. Are there any questions on exercise 10.4a? No questions? Let's move on to 5a. Then 6a, 7a, 9a. We're not going to get all these done, of course, but I might go ahead and work a problem after working a couple more exercises here. All right, let's start a new page. All right, let's see. Excise and sales tax calculations. Clifford Company just billed a customer for $1,100. In this amount includes an 8% excise tax and a 2% state sales tax. What amount of revenue is recorded? And what's the journal entry? So what's the revenue? What's the sales revenue? What's the journal entry? So there's a formula that has to hold then. Sales revenue. Go back and look at this. $2% of sales revenue goes to the state. 8% of sales revenue is an excise tax. So sales revenue times 0.02 plus, so this is the state sales tax, plus sales revenue, whatever that is, we don't know, we're going to solve for it, times 0.08. This is the excise tax, plus sales revenue, of course, needs to equal 1,100, right? We're billing the customer for what they owe us for the product, plus we're billing them for the sales tax, state sales tax, plus they're paying the excise tax. And so when we solve this equation for sales revenue, you know, if you think this equation here, this part, the left-hand side of the equal sign, I mean, you think of this as x, this is x, and this is x. So 1x plus 0.02x plus 0.08x. So that is 1.10 sales revenue equals 1100. Therefore, sales revenue equals 1100 divided by 1.1, or $1,000. So this is part A. There's the answer. How much revenue? 1,000. What's the journal entry? Well, did they pay us cash or did we just bill them? We just billed them. Didn't say anything about they paid us. So we're not going to debit cash. We didn't receive any cash from them. We're going to debit accounts receivable for 1,100. We're going to credit sales revenue. Recognize the revenue, 1,000. And we're going to credit sales tax payable. They owe us for sales taxes, but we have to turn around and take that amount that we collect from them, and we owe that amount to the government. So from our standpoint, it's a liability we owe. We also owe for excise taxes, excise tax payable, just additional tax we owe to some governing body. It's like a tariff. How much is the sales tax payable? It's 0.02 of sales revenue, right? This is the sales tax. And this was the excise tax. So 0.02 of 1,000 is what? 20. And then 0.08 of 1,000 is what we owe for excise taxes. So there we go. The debits and the credits equal. That's the answer to part B. Just remember, these amounts we collect from the customer, but we have to turn around and give them to some governing body. Taxes. Any questions on exercise 10.5a? Nothing? All right, let's continue with, let's try 6a. Let's see what 6a about first. I don't want to repeat something that we've already done. All right, so this is a different concept. Advance payments for goods. The Petaluma Daily Times Corporation publishes a daily newspaper. A 52-week subscription they sell for $260. Assume that they sell 100 subscriptions on January 1st. As of March 31st, none of those subscriptions have been canceled. Part A, prepare a journal entry to record the receipt of the subscriptions on January 1st. And B, prepare a journal entry to record 1 week of earned revenue on March 25th. All right. Magazine subscriptions, newspaper subscriptions, airline tickets, rent. These are things that the seller receives money in advance before they earn the revenue. So the newspaper corporation, CDT, the Petaluma, whatever their name is, on January 1st, they get $260 from each of their 100 customers. So 260 times 100, they would debit cash. 260 times 100 is $26,000. and they would credit a liability, unearned subscription revenue. And you don't have to be that specific. You could just credit unearned revenue. But to be specific, it's unearned subscription revenue, 26,000. So the 26,000 again is, put a star by that. That's calculated as $260 per subscription multiplied by 100 subscriptions. Part B, prepare a journal entry to record 1 week of earned revenue on March 25th. So what's going to happen is each week they deliver a newspaper to a customer. Therefore, each week they earn 1/52 of $260 for each customer. They earn 1/52 of $260. $260 is the amount that they receive from each customer. In exchange, they have to give each customer 52 weekly newspapers. So each week, they're going to make the following journal entry. They're going to debit the liability, unearned subscription revenue. For how much? So they're going to reduce a portion of this liability because each week they just asked us to do the week that ends March 25th, fine, whatever. But it doesn't matter what date the week ends on. All the weeks, the journal entry is going to be the same. We're going to get rid of, so for each customer, we earn 1/52 of $260, and we have 100 customers. So this will be double star. So the number, we're going to reduce this 26,000 by $500. Debit unearned subscription revenue, credit subscription revenue. We're recognizing revenue because we delivered a newspaper to each of our 100 customers for this week. So 52 journal entries just like this throughout the year. And 52 times 500, guess what it equals? 26,000. So at the end, we won't have any more liability, and we will have recognized $26,000 of revenue. Any questions on, well, should have set this apart. Might be a little confusing here. This is a different exercise. Any questions on exercise 10.6a? This is how unearned revenue works. Hopefully you guys already kind of know this. I think we've covered this in a previous chapter, this concept. What else should we work here? What's 7a about? Warranties, okay, we can do warranties. Zealand Company sells a motor that carries a 3-month unconditional warranty against product failure. Based on a reliable statistical analysis, Milford. I think this is a typo. This should be Zealand. Zealand Company knows that between the sale and the end of the product warranty period, 4% of the units sold will require repair at an average cost of $60 per unit. The following data reflect Zealand's recent experience. Each month we have units sold. We have the known product failures from sales in that month. Or a later month. Or an earlier month, sorry. So for each month, we have units sold, and also for each month, we have the known product failures from sales in that month or an earlier month. Right, some units we sold in October could fail in October, or could fail in November, or could fail in December. So we have this table here, and then it says calculate and prepare a journal entry to record the estimated liability for product warranties at December 31st. Assume that warranty costs of known failures have already been reflected in the records. All we have to do is estimate the warranty costs for unknown failures. The failures we estimate will happen, predicted failures. And again, we're going to have to rely on this idea that our estimate is that 4% of units sold will require a repair. So at December 31st, we kind of need to treat this month to month, don't we? Let me think about this for a second. Do we have to treat this month to month, or can we just get a total number of units sold and multiplied by 4%? Let me think. No, we have to do this month to month, because in each month, some failures have already happened, and we have to take those away from our expected failures, right? Our expected failures is some number. Then some known failures have already happened. Subtract the known from the expected, and that's what we still expect to happen. You might wonder, well, what if the known failures are more than what you expected in a given month? Well, in this problem, that's not the case. And you won't have a problem where that is the case. All right, so we have to set up a table where in the columns we have the months. And then in the rows, we have first units sold, then, well, the estimated failure rate, which is 4% across the board. And then the failures that have already happened in that month. And, oh, whoops, I left off a row. All right, jumped ahead. So after the estimated failure rate, we need our total estimated failures. Then the failures that have already happened, and then we subtract the failures that have already happened from our estimated failures to get our expectation of future failures. Each of those estimated future failures carries with it an expected cost that we're going to have to incur of $60 to repair the thing. So then we can add up all those expected future failures, multiply by $60, and that's the warranty. That's the dollar value of the liability we have to recognize at the end of the year. So units sold in October was 23,000, November 22,000, December 25,000. Estimated failure rate multiplied by each of those numbers gives the estimated failures in October to be 920, November 880, and in December, 4% of 25,000 is 1,000. In October, the failures that have already happened that were given to us, 460. Wait, let me think. Yeah, failures related to units sold in October are 460. 120 of those occurred in October, 180 occurred in November, and 160 occurred in December. But if you add this 120, 180, and 160, you get 460 failures occurred related to the 23,000 units sold in October. So 460 And then failures that have occurred relating to these 22,000 units sold in November, 350. And for December, 210. So this row is given to us. This row is given to us. This row we have to calculate. And then, of course, this row we have to calculate. So estimated failures in October, units that failed relating to the October sales, 920. That's our estimate. How many actually happened? 460. What do we think still will happen in the future going forward? Like in January, February, some of our units that were sold in October, we expect to fail. How many? Another 460. So that's the 920 minus the 460. 880 minus 350 is 530 for November. And 1,000 minus 210 is 790 for December. Each of these failures, and the total is total failures, total, maybe I should be more specific, total expected future failures. So as of 12/31, total expected future failures equals 460 plus 350 plus 790, or 1,780. Each of these failures comes with an average cost of, so multiply by $60. That's what we're going to have to incur to repair the item. And so that gives us a total liability, total estimated product warranty liability as of 12/31 equal 1,780 times $60 per failure is $106,800. What else does it ask for? It says calculate the number and prepare a journal entry. So what's the journal entry? We debit product warranty expense. So this number is an expense, goes on our income statement, and we credit estimated liability for product warranty. So this is an example of a contingent liability. This is the journal entry on 12/31. Debit product warranty expense. Credit estimated liability for product warranty, or estimated warranty liability. Maybe that's easier to write. Let's write that. Estimated warranty liability. So this is an example of a contingent liability. It's an obligation that we are likely to incur in the future, and we can reasonably estimate the amount of that obligation. And therefore, under GAAP, those types of liabilities have to be recorded. Any questions on for exercise 10.7a? All right, let's keep going. 10.9a. Let's see how much time we have. About 35, 40 minutes left. I will use the whole time because I feel like this chapter has lots of questions, lots of different concepts, and students tend to have difficulty with chapter 10. So, early retirement of bonds. Eaton Company issued $600,000 of 8% 20-year bonds at 106 on January 1st, 2013. So I assume that you watched the bond video, not the bond video, the chapter 10 lecture I put up. In that lecture, I talked a good deal about bonds. So I assume you've watched that. I'm not going to lecture again over it, bonds. I will assume some level of coherence in relation to understanding what bonds are. And we'll go from there in solving these questions. For example, I assume you know some of the terminology relating to bonds based on watching the lecture. So let's put the face value of the bonds is 600,000. I haven't even looked at the question yet. I'm just writing down what we know. The face value is sometimes called the maturity value or the principal. There's different names for these things. They all mean the same thing. 8%, this 8% here, right here, this is the stated interest rate. It's the rate that's stated on the bond certificate. Usually it's called the stated interest rate. Sometimes it's called the coupon rate. All right. 20 years. This is the term of the bonds. This is also stated on the bond certificate. So the term, 20 years. These bonds were issued at 106. This 106 is not something that's stated on the bond certificate. This 106 is given to you so that you can calculate the issue price. I can either give you the issue price directly, or I can give it to you indirectly by telling you that the bonds were issued at some percentage. In this case, 106. So issue price must equal the 106, or 106 means 106%. 106% of what? 106% of face value. Or I could say bonds were issued at 98. 98% of what? 98% of face value. So that telling you the 106 or the 98, whatever this factor I give you, that's information I'm giving you so that you can find the issue price. Or I can give you the issue price directly. Here I'm giving it to you indirectly. By telling you this, you know you have to multiply it by the face value, and that was the issue price. This product here. So 1.06 times 600,000 is actually what the borrower received from the lender on the date that the borrower issued the bonds to the lender. So Eaton's going to get $636,000 on January 1st, 2013. What are they giving in exchange for that $636,000? They're giving a bond certificate, which essentially is a promise that they're going to pay $600,000 back to the lender 20 years from now. So on January 1st, 2033, that's 20 years from January 1st, 2013. In addition, they're going to pay the lender 8% interest. That's the annual interest rate. They're going to pay the lender 8% interest every year, but their interest is paid semi-annually. So essentially, they're going to give the lender 4% interest every half year. Every 6 months, they're going to write a check to the lender for 4% of $600,000. Plus, at the end of 20 years, they're going to give the lender back $600,000. So in exchange, the lender is going to give them $636,000. But over the course of the 20 years, they're going to pay the lender way more back than they receive, which of course is true. It's a time value of money. So it's not like the borrower is getting away with, it's not like you give me $5 and I only give you back 4. No, I'm giving you back 8, but over a long period, I'll give you back more. you're going to get, the borrower definitely is going to pay the lender back more than 636. All right, what else do they say? Through January 1st, 2019, so that's 6 years. Let me think, 13, 14, 15, 16, 17, and 18. So through January 1st, 2019, that's 6 years, Eaton has amortized $5,000 of the bond premium. We'll talk about what the premium is here in a second. And amortized is another word for reduced. So they've reduced $5,000 of the bond premium. On January 1st, 2019, Eaton retires the bonds at 103 after making the interest payment on that date. Prepare the journal entry to record the bond retirement. Essentially, what has happened is Eaton's the borrower. 6 years into the life of the bonds, they decide that they want to retract their promise. So that bond certificate that the lender holds in their hands, they no longer hold it anymore. It's not a promise anymore. They're not going to receive $600,000 on January 1st, 2033. 6 years into the bond term, the borrower decides to retire the bond. So the lender is going to take something in exchange for that. And so what the borrower does is the borrower retires the bonds at 103. 103 of what? 103 of face value. So 6 years into the return, Eaton's going to pay 1.03 times $600,000 to the lender in exchange for the lender saying, you no longer owe me anything, right? The bond certificate is canceled, null. So the lender will have received 12 interest payments already, right? Because 6 years have gone by and they're paid interest semi-annually. So the borrower will have paid the lenders 12 interest payments, plus they're going to pay them this fee to retire. What's the journal entry to record the bond retirement? Okay, we have to talk about this premium, all right? So this bond was issued at a premium. Why? Because issue price is greater than face value. When that happens, the difference between issue price and face value is a premium. When the issue price is less than face value, the difference between the two is called a discount. Why is the issue price greater than face value? We'll talk about that in probably a problem coming up, but it has to do with the market interest rate on bonds similar to these bonds relative to this bond's stated interest rate. This bond's interest rate, stated interest rate, must be greater than the market interest rate, and that's why the borrower is demanding to receive more than face value from the lender. Therefore, there's a premium. So the premium is the issue price minus the face value. And so it's equal to the $636,000, what the borrower receives, minus what the borrower promises to pay back at the end of the bond term. This premium has to be amortized over the life of the bond, or reduced down to zero. So over the 20-year term of the bond, the premium has to be amortized. There's two methods you can use to amortize this premium. You can use the straight line method. You're responsible for knowing how to do that method on the exam. Or you can use the effective interest method. You're not responsible for that on the exam. That is Appendix 10A. That's in Appendix 10A. You are responsible for part of Appendix 10A, the straight line method, but not the effective interest method. In this problem, it doesn't say what method they use. So we can just use the straight line method to amortize this premium. The reason the premium matters is because when you retire a bond, you have to take the bond off your books, the bond payable, and you also have to take the premium on bond payable off your books. So here's the journal entry. They don't ask for this, but here's the journal entry on the date of issuance. When we issued these bonds on 1/1/2013, Eaton issued the borrower. We gave this bond certificate, which is essentially a promise to repay the lender. It's just a promise to pay the lender to pay them a lender amount at a future date. When we did that, we received $636,000, and so the journal entry, debit cash, $636,000, credit bonds payable, right? Because we've given them this promise that we're going to pay them back $600,000 20 years from now. And the difference is credited to an account called premium on bond payable. Premium on bond payable is an adjunct account to bond payable. Premium on bond payable starts with a balance of $36,000. So let's look at the T accounts. Bonds payable, it's a liability, so it has a credit balance of $600,000 as of January 1st, 2013. Premium on bond payable, it's an adjunct liability. So the opposite of a contra account is an adjunct account. So premium on bond payable is attached to bond payable. It's an adjunct account. It increases the balance in bond payable. It has a positive relationship to the bond payable account. A contra account decreases the balance in the account that it's contra to. Premium on bond payable, because it's an adjunct account, it has the same normal balance. So it starts off with a credit balance, $36,000 on January 1st, 2013. Now, every 6 months, Eaton has to pay interest to the lender. When they pay the interest, that's when they reduce the premium on bond payable. So on July 1st, 2013, they're going to reduce a portion of this premium. When are interest payments due? July 1st and January 1st. On 1/1/2014, they're going to reduce a portion of the premium, and so forth. So as of January 1st, 2019, Eaton will have made 12 interest payments, right? 6 years have gone by, and including this payment right here, that will be the 12th payment. So we need to make the journal entry for interest. For interest expense. It's going to be the same journal entry each time. Every 6 months, they're going to make the same entry. This was the journal entry for the issuance of the bond. They don't ask for these things, but we need these things to help us solve what they ask for. So every 6 months, starting, when's the first interest payment due? July 1st, 2013. Every 6 months, starting on July 1st, 2013, they're going to make this journal entry. They're going to debit interest expense. They're going to debit premium on bonds payable. They're going to reduce a portion of the premium. They're going to make an entry here. And they're going to credit cash. Let's first figure the credit to cash. I'll put a star by this. How much interest do we pay the lender? Well, we promised on our bond certificate that we would pay them 8% interest per year of the face value. But only 6 months has gone by. So we multiply by 6/12. So again, interest we owe them, that we're going to pay them, is face value times interest rate times time. See, this is the difference between a bond and a note. With a note, you don't have to pay the interest or the principal until the maturity date. With a bond, you pay the principal on the maturity date at the end of the bond term, but you pay interest periodically. That's the cool thing. From the lender's standpoint, it's like an investment. You're getting this check every 6 months from the borrower. So from Eaton's standpoint, we're going to credit cash for 600,000 times 8% times a half. Which is $24,000. Every 6 months, we're going to cut a check to the lender for $24,000. That's the interest we owe them on this bond. We're going to reduce the premium on bond payable account. How much do we reduce the premium on bond payable account? Again, it depends on whether you use the straight line method or the effective interest method. So assuming straight line method is used, the number would be, so assuming the straight line method of amortizing the premium or reducing the premium, we would just, so this number here, which I'll double star it, would be calculated. You just take the starting balance in the premium account and you divide by the number of interest periods. So it's a 20-year bond. And initially we started out, it was a 20-year bond, and we pay interest 2 times every year. So that's 40 interest payments. So each time we make an interest payment, we're going to reduce the premium by the same amount. The straight line method reduces the premium by the same amount each time. The effective interest method reduces the premium by a decreasing amount each time. But to calculate that, you have to use a table. We're not going to do that. So we're going to reduce the premium by 900 every time we pay interest. Therefore, the interest expense, so you solve for cash and then the premium first. You solve for cash and the reduction of the premium first, and then the plug is just the interest expense. So the interest expense is 24,000 minus 900, or $23,100. So when we're dealing with bonds sold at a premium, the interest expense each time we pay interest is less than the cash interest paid. Notice 23,100 is less than 24,000. When we're talking about bonds originally sold at a discount, the interest expense will be more than the cash interest paid. Everything's flipped when we have a discount. Same debit, same credit, but in terms of the accounts, but we would be crediting discount on bond payable. So 2 credits and 1 debit. We'll do a discount example later. So that's the journal entry every time we pay interest. We still haven't solved the question yet. They want us to do the journal entry when they retire the bonds. Now let's talk about retiring the bonds. So let's go back to our premium on bond payable account. We will have made 12 debits to this account for $900 each, right? Because every time we make a journal entry for interest, we're going to reduce the premium by $900. So as of January 1st, 2019, what's the balance in the premium on bond payable account? 900, 900, dot, 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 900, 12 times. So as of 1/1/19, after we make the interest payment on 1/1/19, 900 times 12 is 10,800. So we subtract 10,800 from 36,000, and the balance in the premium on bond payable account will be 25,200. Have I messed up on this? I hope I haven't messed up, but I think I have, looking at the solution. I'm trying to figure out where. I got the right ideas. I just calculated some number wrong, so I'm not getting the same numbers, but this is all the right, this is the right concept. It's 36,000 divided by 40 is 900. 36,000 is the premium balance starting off. They were issued at 106. 600,000 times the 1.06 is 636. Yeah, so all that's right. Where am I going wrong here? We made 12 interest payments. July 1st, 2013, that's the first one. And then 14, there's 2 more, that's 3. 15, there's 2 more, that's 5. 16, there's 2 more, that's 7. 2017, there's 2 more, that's 9. 2018, that's 2 more, that's 11. Maybe 11, no. Oh, 12. I think maybe there's a problem with the solution online. I don't see where I've messed up any. 8% is the interest rate, right? Let's see. 8% is the stated interest rate. 600,000 times 0.08 times 0.5. 24,000 is the cash interest paid. No, I think we've done everything right. So I don't know why the answer key says it. So the balance in the premium on bond payable account on January 1st, 2019 is $25,200. And now we have to retire the bonds. So the journal entry for the retirement, they retire the bonds on, it says right here, on January 1st, 2019, Eaton retired the bonds at 103 after making the interest payment on that date. Prepare the journal entry to record the bond retirement on January 1st, 2019. So first of all, we have to get rid, we've just retired the bond, which means we no longer have that promise to repay the lender. That bond certificate that they have in their hands, they can just tear it up. So we can get rid of our bond payable. What's the balance in bond payable? The balance in bond payable stays over here at 600,000 until we retire the bonds or pay the bond off. So get rid of that balance. Debit bond payable for 600,000. So now when we debit bond payable for 600,000, we no longer have that obligation. This balance is 0. We also have to get rid of whatever the balance in the premium on bond payable account is, which I'm saying it's this. The answer key says it's something else. I think the answer key may be wrong unless I've messed something up. So get rid of the balance in the premium on bond payable, $25,200. Let me just check one more time. 900 times 12 is 10,800. And then we credit cash for, what did we have to pay to retire the bonds? We retired the bonds at 103, which means we had to pay 1.03 or 103% of the face value, our original promise. So that is 618,000. So it's just the 1.03 times face value. That's what that means. So we had to cut a check to the lender for $618,000 in order for them to shred their bond certificate and not legally hold us responsible to pay them that $600,000 back at 20 years from 1/1/2013. And then it looks like we need another credit, right, to make the debits and credits equal. So since we need another credit, we'll call that gain on retirement of bonds. Gain on retirement of bonds. So that's the plug here. The debits total $625,200 and the credits total $618. So it looks like we need another $7,200 credit. So we essentially we have a gain, right? We reduced our liabilities by $625,200, reduction in liability. And to reduce those liabilities, we only had to reduce our assets by $618. So we realized a gain here. Usually to reduce a liability by $1, you got to reduce your assets by $1 to satisfy it. In this case, we didn't have to reduce our assets by as much as we reduced our liabilities, so there's a gain. If the credit to cash here was bigger than these two debits, then we would need another debit, and the debit would be called loss on retirement of bonds. So this is the answer to the question. This is the journal entry on the date you retired the bonds. Notice though, to get that, I mean, you can get this debit here without doing anything. You can get this credit here without doing anything, but you can't get this right here. You have to go and track the premium on bond payable account, and you need to know what its balance is on the date you retired, because that's the balance you have to take off. So now when we debit premium on bond payable for $25,200, it has a zero balance, which it should. And so that's why you have to do all this to get this number. And then of course, this number won't be right unless you have this number right. So you won't know if you have a gain or loss unless you've done this, worked all this out. So this is the answer to the question. So I know it's a convoluted question, and I kind of went through some extra information I didn't need to go through to answer the question, but all in an attempt to help you understand bonds a little better, since this is the first problem we've worked with bonds. Now there's a question. Let's see what the question is. Somebody has a question. Yeah, Ben, you're right. That's why the answer key says that. Okay, let's go back. I did too much. It says in the problem, like you said, you're right, you pointed out, it says through January 1st, it's this sentence right here. This is the key sentence. Through January 1st, 2019, Eaton has only amortized $5,000 of the bond premium. How much did we say they had amortized? We said they had amortized $900 every time times 12. That would be the straight line method, or 10,800. When you subtract 10,800 from 36,000, you get 25,200. But the problem just says they've only amortized 5,000. So they must have been using the other method, the effective interest method. And every time you amortize under that method, it's a different amount. When you multiply those when you add up those different amounts 12 times, it must have equaled $5,000. That's what they're telling us. So in other words, don't use the straight line method, basically. Just use whatever they gave us. So they basically, what they've amortized is $5,000 in total. We don't know what the individual ones were. We just know the total would be, the total of all these entries is $5,000. And if that's the case, then the balance in premium on bond payable is not 25,200, it's 31,000, right? 36 minus 5. And that changes our answer then, right? This changes to 31. And then of course our gain changes as well. Now we need an additional credit of not 7,200, but the difference between 631 and 618, which is 13,000. So there's the correct answer. If you just change this question, if you take out this sentence, if you replace this sentence right here with the following sentence: Eaton uses the straight line method to amortize their premium. If you replace the sentence I've highlighted with the sentence, Eaton uses the straight line method to amortize their premium, then what we originally did is correct. We did the straight line method originally. Any questions on exercise 10.9a? Any additional questions? Thank you, Benjamin, for pointing out the, I wasn't using that information they gave me. I was doing the straight line method. I can anticipate there would be more questions on this one, but maybe you just need to practice more and you don't know which question to ask. That could be the case as well. You're definitely going to have to practice this. I think the homework in chapter 10 gives you good practice on these concepts, especially relating to bonds. There are quite a few questions on the exam 3 relating to bonds. Another question just came in. Let's see. Christopher says, can you show the journal entry for interest expense again? Yes. If they use the straight line method, this would be the journal entry they would make for interest expense each time they pay interest. All right. The credit to cash is what the borrower has to pay the lender for interest every 6 months. It's equal to face value, because that's what's on the bond certificate. That's what's on the piece of paper, the promise that the borrower gave the lender. The lender has this promise from the borrower that says, I'm going to get 8% of 600,000 every year from the borrower. But the borrower said we'll pay the lender every 6 months. So they're going to get 4% of 600,000 every 6 months. So the borrower, from the borrower's perspective, we would credit cash for 24,000. This chapter is liabilities. So everything's from the borrower's perspective. You could just imagine on the lender's books, when they receive this cash from Eaton Company, the lender is going to debit cash for 24,000 and credit interest revenue. But borrower credit cash for 24,000, and then you're going to be debiting the premium on bond payable, because we have to amortize the premium. Every time we pay interest, we have to subtract a portion from this balance. So we have to debit the premium on bond payable account. The question is for how much? How much depends on which method you use for amortizing the premium. If you amortize based on the straight line method, it's the same amount every time. You just take the initial premium and divide it by the number of interest payments. That's what I had done down here. And you get the $900. So you debit the premium for $900, and then the interest expense, this number is actually the plug. You can't find this number without first finding this number and this number. And this is the plug. Does that help, Christopher? You're welcome. We have 3 minutes left. 10A seems you guys can, that's not too bad. 12A, it's 12A. 12A is basically, you have to understand there's 2 criteria for whether a given contingent liability is shows up on the financial statements. You have to make a journal entry for. If the given thing satisfies 2 criteria, then you have to make a journal entry and it shows up on the financial statements. Otherwise, if it satisfies doesn't satisfy both but meets another condition, then you have to disclose it in the notes of the financial statements. And then if it doesn't satisfy either of the criteria, then you don't have to disclose it at all. And so that's in chapter 10 as well. You can go look at those criteria. It's in the lecture as well. I don't think doing this problem is going to, you guys can do that one, I think, on your own. I'm just trying to do things that mainly the bond stuff, because that's stuff that people have trouble with on their own the most. So problem 10.4a, I guess we're running out of time, but I think I'm going to do problem 10.4a if it's a bond one anyway. And if you have to go, that's fine, but at least you'll have the video to go back and look. Except I think it's important. So let's go ahead, find the problems. All right. Problem 10.4a, yeah. I'll do 10.4a. This is not related to bonds, but it's the other trickier concept in the chapter, which are payroll taxes. And then problems 10.7a is a bond one. So I think I'm going to do both of these. And so if you have to go now, that's fine, no problem. You can watch the video later. I'm going to upload the video to YouTube. But if you can stay, that's even better, because then you get to see me. I usually wouldn't go over, but I feel it's important. So this is problem 10.4a. So the following data are taken from Stockton Wholesale Company's May payroll. So we have all these salaries, their total payroll that they owe their employees for May, $108,000. All of that is subject to the 1.45% Medicare tax. 85,000 of the 108 is subject to the 6.2% Social Security tax. 14,000 of the 108,000 is subject to federal unemployment taxes. 21,000 of the 108 is subject to state unemployment taxes. And the federal income taxes that are withheld from all salaries is 17,800. So what happens with, for every dollar an employer, for every dollar in salary that an employee earns from an employer, the employer has to pay a Medicare tax, a Social Security tax, and these are the rates on that dollar, to the federal government. And the employee has to pay those same rates for Medicare and Social Security on that dollar to the federal government. But instead of letting the employee pay that to the government on their own, the employer will withhold twice. So they'll withhold, what's this total here? 7.65. They'll withhold 7.65% of that dollar from the employee's paycheck and pay that for them to the government. And of course, the employer has to pay 7.65 of that dollar themselves to the government. So the government gets over 15% of each dollar made by an employee for Medicare and Social Security. That's what funds a lot of our healthcare system and our retirement funds, so people live on Social Security. Also, employers have to pay dollars on employees' salaries to the government, and this money is used to fund unemployment. They have to pay the federal government and they have to pay the state government. And of course, the employer withholds income tax, federal income tax from employees. The employees have to pay the 17,800 if the employer didn't withhold it from them in the first place, right? You'd have to go ahead and pay it yourself, but the employer withholds it from your check usually and pays it to the government on your behalf. So hopefully that makes sense. Assume the company is subject to a 2% state unemployment tax and a 0.6% federal unemployment tax. Record the following. Make a journal entry on May 31st for each of these things. So on Part A, we have to make a journal entry for the monthly payroll. So let's go and do that. All right. So we look here at the information given again. We're going to have we have to recognize salary expense of 108,000. So we can just debit salaries expense 108,000. But since these salaries are paid to different, we group them by administrative versus sales versus custodial, and we'll keep them separated in terms of the expenses as well. So administrative salaries expense. Sales salaries expense. Custodial salaries expense. And those are the three categories of salaries. Yes, 50, 51, and 7 looks like. So we're putting this all in one journal entry. You don't have to do it in one journal entry, but may as well. So that's $108,000 debited. What are our credits? Well, the first thing I'm going to do is federal income taxes that we're withholding from our employees' paychecks. But we don't get to keep the money. We have to turn around and give it to the government. This $17,800. So from our standpoint, it's a liability. It's called federal income tax withholding payable to the federal government. We withhold the money from their check, and we turn around and give it to the government, to the IRS. Go ahead and misspell withholding. There's two H's. Withholding payable. All right, what's next? The Medicare and the Social Security tax. Whoops. The Medicare and the Social Security tax. And these two collectively are known as FICA taxes because the federal government required these taxes to be paid after an act was passed by Congress called the Federal Insurance Contribution Act, I think, FICA. And after it was passed, the federal government started collecting these taxes. And they used this money from employers to fund Medicare and Social Security. So it's just called FICA. Medicare and Social Security, collectively known as FICA. This is an acronym for the act that was passed by Congress to allow the federal government to take money from employers to fund Medicare and Social Security. The Federal Insurance Contribution Act. I can't remember what year it was passed. I think in the 1930s. Maybe later than that. I'm not sure. I'm not a history buff. FICA tax payable. What is Stockton Wholesale Company's FICA tax payable for May? Well, they gave us these rates. 1.45% of the Medicare tax is payable. So 100, right? 108,000 of salaries. That's all subject to a 1.45% Medicare tax. So 108,000 times 1.45% is $1,566. That's the Medicare portion plus the Social Security portion. So 85,000. Not all of your employee's salaries is subject to Social Security. Don't worry about how to get what percentage of it is subject. That's in the rules, but they tell you 85% or 85,000 of the 108,000 is subject to a 6.2% Social Security tax. So we take $85,000, the amount that's subject to the tax, multiply it by the tax rate, 0.062, and 85,000 times 0.062, $5,270 plus the $1,566, and you get $68.36. This is the amount. This is the amount that the employer is withholding from their employees' paychecks. They have to turn around and give it to the government. In addition, the employer has to give this same amount of their own money to the government. So the government gets 2 times this. This $17,800 is the amount the employer is withholding from the employee's paycheck. And they have to turn around and give that to the government for their income tax, for the employee's income taxes. You might wonder, what about the other $68.36 that the employer has to pay out of their own money? That would be a different journal entry. They would debit FICA tax expense $68.36, credit FICA tax payable $68.36. That's not an amount that, that's not in this journal entry. And then the remaining amount is an amount they owe their employees. So these 2 amounts are amounts out of their employees' salaries that have to be turned over to the government. And the rest is what they give their employees: payroll payable, or wages payable, or salaries payable, if you want to call it that. So the difference between 108,000 and whatever this is together, the difference between those numbers is 83,364. So hopefully this all makes sense here. This is how payroll works. This is why if you're someone, you want to think carefully about hiring an employee and setting up a formal, you want to pay them under the table, but that's illegal. And so when you hire employees and everything's formal and you do things by the books, you got to do this. Uncle Sam dips his hand and gets to get some of your money. But that's how we have Social Security, that's how we have Medicare, that's how we have a lot of our federally funded things. We pay for them through taxes. All right, that's part A. What about part B? What is part B? Payment of the net payroll on May 31st. What's the journal entry when we pay the payroll? This is the net payroll right here. So we would debit payroll payable, or salaries. You can call it salaries payable, wages payable. 83,364. Well, if we called it payroll payable up here, we got to call it payroll payable here, but you can name it what you want. And of course, credit cash, 83,364. This is the check we write to our employees. This represents many employees. Each employee gets a portion of this. Each employee gets their own separate check, of course. That's on 531. What journal entry is required for part C, 531? Accrual of the employer's the employer's payroll taxes. Assume that the FICA tax matches the amount withheld. Now we're going to make a journal entry for the amount the employer owes, not based on their employee. It's not amounts that they're taking out of their, it's based on their employee salaries, but it's not the amount they're withholding from the employees to turn around and give it to the employer on the employee's behalf, but the amount that the employer is giving to the federal government on the employer's behalf, on their own behalf. The government collects from both parties, employee and employer. So we would just debit payroll tax expense, like I had said earlier. Credit, we owe an amount to the government for FICA, and we owe an amount to the government for unemployment taxes. And then state unemployment tax payable. We owe federal and state. So with unemployment taxes, the employees don't pay into that fund. And with unemployment taxes, that's why you didn't see that up here in this journal entry. The employees don't pay into that. So the employer is not withholding money from the employees and giving it to the, because the employees don't pay into that fund. Who pays, how is unemployment funded? It's funded by only employers. So there's an additional two things we got to recognize as an employer. All right, what's the amount we owe for FICA tax payable? It's equal to the amount we withheld from the employees. So, oops, I can just go back up here. How much did we withhold? $68.36 right here. That's how much the employee is giving to the federal government. Well, we're giving it to the federal government on their behalf. And we also have to get that amount from ourselves as well, $68.36. It's calculated as a percentage of employee salaries right here. And then we owe unemployment tax. And what does it say here? How much of our employee salaries are subject to federal unemployment taxes? Only $14,000. And what's the rate? It told us on the next thing. Assume the company is subject to a 2% state unemployment tax, 0.6% federal unemployment tax. So for federal, it's the 14,000 times 0.6%. And for the state, it's the 21,000 times 2%. So I'll put a little star right by this one. Star is the amount of our employees' salaries subject to the tax times the rate we have to pay, which is 0.6% or 0.006. And for the state unemployment taxes, it's the amount that's subject to the tax, which was $21,000, times the rate, which was 2%. 21,000 times 0.02. And that should give us our two unemployment tax payable numbers. So $84 for federal unemployment taxes that we owe. And for state unemployment taxes, the rate is always higher. The state takes more. Unemployment usually funded at the state level. Like if you're an employee of New York and you get laid off and you want to file for unemployment, you're going to get a check, and that check, you can get two checks. You get a check from the federal government and from the state government. The check you get from the state government will be bigger because the state takes more. That's a bigger fund. All right, and then part D. What is part D? Payment of these payroll-related liabilities. So part B, we recorded the payment of the liability we owe to our employees. Now let's record the payment of the liability we owe to the government, the various government agencies. So we would debit all the payables. We would debit, if we go back to up here, Our first payable was our federal income tax, which we withheld. We owe that to the government on our employees' behalf. So we want to debit federal income tax withholding payable. Now we're turning it over to the government. So we want to debit that for $17,800. We want to debit the FICA tax payable. Now, FICA tax payable, we owe to the government our own FICA tax and the amount we withheld from our employees' checks. So we can just debit it for the 2 times that. Since we credited it twice for that, we can just debit it for 2 times 6,836. We just want to make one journal entry, 13,672. We can debit the unemployment taxes payable and state unemployment tax payable. These are the taxes, the payroll related taxes that the employer has to pay periodically throughout the year, usually every quarter. Technically, they don't have to pay the federal unemployment taxes or the state unemployment taxes every single time they do payroll. They have to do it at least once every quarter. They could do it every single time they pay their, but they at least have to do it every quarter. They can't just wait till the end of the year and cut a check. The government wants the money as soon as possible because they can invest the money and earn a rate of return. The government can. They can invest this money into a big fund and it can get earned return, and then the fund can grow bigger. So we have a bigger unemployment fund, a bigger Social Security fund, a bigger Medicare fund, and so forth. So essentially, we're just getting rid of these liabilities that we originally established. This one was for 84, this was for 420. Now we're paying it. So debit the liabilities, and how do we satisfy the liabilities? We got to get rid of an asset, in this case cash, credit cash, for the sum of all these, which is 31,976. And that is exercise 10, or problem 10.4a. Did you have any questions in regards to this particular problem? Anybody who's left? There's 10 people left. Any questions? It seems a little tricky, but once you get this idea, all right, the employer has to withhold some stuff from the employee, give it to the government. Other stuff they have to pay themselves to the government. And you keep these 2 things straight in your head. It's not too bad, really. There's essentially 4 things the employer has to give to the government, whether on the employee's behalf or on their own behalf. Employees' income taxes, employee and employer FICA taxes, employer federal unemployment taxes, state unemployment, employer state unemployment taxes. There's 4 categories. All right, as promised, let's work problem 10.7a, the last one. This will be a longer upload, but that's okay. The good thing about our uploaded video, you can fast forward it and go to the part you want to see. Bond payable journal entries. This is where a bond is issued at par. Now, if a bond is issued at par, that means the issue price and the face value are the same. So Ashton Incorporated, which closes its books on December 31st, is authorized to issue 800,000 of 9% 20-year bonds dated May 1st with interest payments on November 1st and May 1st, every 6 months. Prepare the journal entries to record the following events. Assuming that the bonds were sold at 100 plus accrued interest on October 1st. If a bond is sold at 100, that just means it's sold at 100% of face value. So the issue price and face value are the same. There's no discount or premium. It's not sold less than face value. It's not sold for more than face value. It's sold at face value. There is no discount or premium. So that's nice. You don't have to worry about the premium on bond payable account or the discount on bond payable account. That makes things much simpler. If you don't have to worry about those accounts, then you don't have to worry about amortizing those accounts because they don't exist, which means you don't have to worry about the straight line method or the effective interest method or any of that. So let's do these journal entries. This question is just testing your knowledge of what happens if a bond certificate is dated this is a date problem essentially. Dated May 1st, but not issued until October. So it's not issued the same day that it's dated. That's essentially what this question is testing. It's a dates thing. So A. All right. The company is issuing the bond issuance. We're supposed to record the journal entry for the bond issuance, and it's made on, of course, October 1st of whatever year. Well, if the borrower is issuing bonds, they're receiving cash, so we're going to debit cash. How much do we receive? We're going to receive 100% of face value plus accrued interest because the bonds are dated May 1st. Between May 1st and October 1st, time has passed by. And so usually when you issue a bond at a date later than the date on the bond, you usually, but not always, you have to you demand to be paid the face value plus any accrued interest. But not always. The problem has to state, and here it states it. It says sold at 100 plus accrued interest. So we know we're going to get, what's the face value of the bonds? We're going to get the face value plus accrued interest. The face value was 800,000. So let's write this information down here so we don't have to keep switching pages. So face value, 800,000. Stated interest rate, 9%, says right here. And the term is 20 years, and interest is paid semi-annually. There's 40 interest payments, twice each year for 20 years. So we know we're going to get 800,000 on October 1st, but we're going to get accrued interest as well. How much time has gone by between May 1st and October 1st? That's the question. So the amount we're going to debit to cash, the issue price, the amount we're going to receive from the lender is going to be the face value plus accrued interest. So it'll be accrued interest up here. Accrued interest. How many months? So we know the accrued interest is going to be face value times interest rate times time. How much time has gone by in months between May 1st and October 1st? I think that's 5 months. So we times 5 over 12, and that is our accrued interest that we're going to get in addition to the 800,000. So it's $30,000. So this is going to be 830,000 we're going to receive from the lender, and we're going to credit bond payable. We don't have to worry about a premium or a discount because bonds are issued if they're issued at 100, they're issued for face value. And so you might wonder, well, what about the extra 30,000? That's not a premium or discount. It's going to be it's interest that we owe. Extra interest we owe. We owe interest from that over that time period, May 1st to October 1st, even though the lender didn't lend us the money until October 1st. They hadn't even lent us the money as of May 1st. We owe interest over that 5 months, even though we didn't have the money. That's how this works. So that's the journal entry on the date of issuance. And then part B. Let's see. Part B, payment of the first semi-annual period's interest on November 1st. So November 1st is 1 month after October 1st. So 1 month later, November 1st and May 1st are the two dates stated on the bond certificate that we're going to pay interest. So November 1st comes around. It happens to be 1 month after we issued the bond, but we owe interest. We're going to debit interest expense. We're going to credit interest payable. No, going to credit interest payable. We're going to credit cash. We're going to credit cash. We're going to debit interest payable as well. We're going to debit interest payable for the $30,000 because we'd owed that. We set that up right here. 1 month later, we're paying that plus the additional 1 month of interest expense for October between 10/1 and 11/1, which is $6,000. So the $6,000 is just principal, face value, times interest rate, times time. 1 month. October, the month of October. And so this 36 is just like taking 800,000 times 9% times 6/12, semi-annual. It's just the way we did this. We had to establish this interest payable right here because our date of issuance was 5 months after our date of the date on the bond certificate, which was May 1st. All right. And then C, accrual of bond interest at December 31st. December 31st happens to be at the end of an accounting period. It is not one of the dates on the bond certificate though. It's not May 1st to November 1st. We don't owe any, we're not paying any interest, but as of December 31st, we do owe some interest. We have to recognize, I guess, 2 months of interest expense, November and December, and 2 months of related interest payable. When will we pay this interest? We're going to pay it on May 1st of the next year. But as of December 31st, if we're making a journal entry related to this bond, which we need to update the accounting records, we have to recognize 2 months of interest expense. So we need to take 800,000 times 0.09 times 2/12, and that will give us $12,000. And then finally, D, well, we got 2 more. D, payment of the semi-annual interest on May 1st of the following year. May 1st, we're going to pay interest. So the semi-annual period from 11/1 to May 1st, we've already recognized 2 months of this period interest expense. We recognize from November 1st to 12/30. We already recognized that interest expense, right? We did that with the journal entry in part C right here. The other 4 months, January 1st through May 1st, we have to recognize that interest expense. We have to get rid of the interest payable we have for the 2 months that we set up here. So for the November and December, get rid of that and credit cash. So what's 4 months worth of interest expense? So it'd be the 800,000 times the 0.09 times 4 over 12, which is 24,000. The credit cash for 36,000. And then part E, we retire half of the bonds, $400,000 of the bonds at 101 on May 1st of year 2, immediately after the interest payment on that date. So half of the bonds we retire. All right, that means we're going to get rid of half of our liability that we initially established, right? The bond payable we initially set up, 800,000. When you retire that, you get rid of that, but we only retired half of it. We retired it at 101, so we paid 101% of that to be able to say to the lender, we're not going to, we no longer have that as a liability anymore. So 1.01 times the 400,000 is 404,000. That's what we had to give the lender. In exchange, they said, you no longer owe us for this 400,000. And the difference is loss on retirement of bonds. 4,000. So 2 debits and 1 credit. That total to the same amount. Right? In order to not have this obligation, we had to give this much up of assets. So since we had to give up more in assets than the reduction in our obligation, the difference is a loss. All right, that's problem 10.7a. Are there any questions on that one? All righty. Well, thank you guys for tuning in, and I hope to have this lecture up as soon as I get done. As soon as I stop this, then I'm going to upload it to YouTube, and you'll find it there. And I intend to send you guys the PDF of the problem 10 on homework 10, which uses the effective interest method, so you guys can at least get the right answer on your homework. You're not responsible for the effective interest method of amortization on exam 3, just the straight line method. So until next time, I will see you guys later.